Okay, welcome back one more time. Chapter 2 for Essentials of Federal Income Taxation. Let's go over this chapter. It has a lot of information. If I can finish it today or next time to some degree, then I will go over the homework problems. If not, then we will just try to cover the material in the book. So it depends on the speed we can go on this. So let's go to read now for this book. Chapter 2, we have tax credit and determination, payments and reporting procedures. So we have a lot of things here to cover. So let's go to next page and see what's inside. So the tax rate that we were talking about is at the lowest 10%, and then it will go to 12%, as you see here. Then next is 22, 24, 32, 35, and 37. So there are different brackets of taxes. You don't need to memorize it, but just so you know, it starts from the lowest 10% and then goes up as the income goes higher. And the tax rate schedule, there's a percentage way to do it, or use the tax table. We covered that last time. I told you where the tax table is at the end of this book, or you can just Google it, and tax table for each year, it is changing. If you are using a software, the software will calculate it for you, but as a sake of learning it, how to do it, we covered that last week. So here we have an example that shows varied filing jointly based on this situation, $100,000 taxable income. In year 2022, what would be the tax liability? So, hey, how you doing? So the tax liability, it's given already to you. If you want to go to tax table and calculate it yourself to see if your calculation is matching with this, then it will be a fun way to see if you like this or not. So using the tax table, $100,000, less $83,550 in the tax rate, it is $16,450. So if you look in the table, it says deduct this, and then this is your tax that's gonna be based on 22%. So for first $83,550 in the tax table, it says your tax is $9,600, but the remaining balance, whatever it is, goes to the next level, next bracket, upper bracket, and that will be 22%. And that's $3,619. Add them up. That's why here we have $13,234 for married filing jointly, $100,000 of income. Okay, so that's anyway not that much issue because you are going to use a software and that will calculate it for you. And here is the tax statement that we were talking about. So in regards to individual tax forms, we covered 1040 last time, the first page at least. If you like to watch that again, it's in the recording. Remember, I'm gonna put this recording in Canvas available to you. It will be also, one thing that I decided to do is, let's say a year from now, you wanna kind of review this. So I decided to put all this in YouTube, and on an annual basis. Next year, I'm gonna do the same thing, right? So in case next year you really missed me and you want to kind of say, hey, where's my teacher? I want to really, listen to his lecture one more time and go over the 23, or 2 years from now, 24 or 25. I think if it takes some time from me, but if I do that recording, download it, then edit it a little bit, take the extras out and put the lecture on the YouTube, technically every year you can go over this with me again as I am teaching. So I will upload it. Let's say for this week, I will upload it again. And you not only have the access in Canvas because you are taking this course, but you will have also same thing in YouTube. So if you subscribe and stay connected, you will see all those stuff year after year if you want to review it. Yes.
What's the name of your YouTube channel?
It's my first name, last name. That's it. Awa Yousefian. Yeah. So just follow that. And in my YouTube channel, I have other accounting courses too, like financial accounting, all chapters, lectures for all chapters, managerial accounting, lectures for all chapters, other good stuff that might be interesting. So if you follow that, you will have access to the information that I'm giving to you even next year after that. As long as I have time to do it and commitment, then you will be always up to date year after year. So the bad thing about tax is this, even me included, the bad thing is you do it and then you learn it and then few months there's nothing going on and kind of easily you start forgetting. So next year you really like to review what was going on again last year. So I think this is a good way to stay connected. Anyway, so let's keep going. If you remember last time, I did show you 1040 2022, and we went over this from top to bottom, at least to some details, not 100% of it, but as much as we could. And that was up to line 15 that we were able to find out what is the taxable income. So one more time, at the top, you have all type of incomes, right? And then in the second portion where it says 2A through 5A and 6A, those are type of interest or dividend that you have. Some of them might be tax exempt, but mostly they are taxable. So the taxable portion will be on the second right column, and then total numbers goes in the last column on the right. And then you add up all your income from tips, from W-2s, and let's say taxable interest, taxable dividend, and you add them up and you get to the point that you have also in line 7, remember capital, I said Schedule D. We're gonna look at Schedule D again in future, but Schedule D is capital gain or losses. We will have a chapter for that, I believe. That goes from Schedule D in line 7. You have adjusted total income in line 9, total income line 9. And then we have adjustment to income from Schedule 1, right? So I talk about this Schedule 1, but I didn't show you. So today, before we start the class, I decided to find the Schedule 1 on Google and show you from the IRS website. But so the Schedule 1 that I was looking at, 2022 was available, but all of a sudden I saw 2023 is kind of available. It's a draft, but I thought, why not? Let's show you 2023. But not all forms are ready. They are still working on it, and all those forms might change in next few months anyway. So it's a draft. As you see here, Schedule 1 has Part 1 and Part 2. In Part 1, we have all those additional incomes that might happen. So if you go line by one, you will see, let's say I see in line 8A, gambling. You see gambling, line 8A, that's the gambling. Taxable refund credits, offset of state and income taxes. This is something that I believe it's important, it happens. I might spend a little bit of time to tell you about this for now. And that's that. What is that? Normally when you get state tax refund, you get happy, right? But if you have itemized it already to get to the point that you have state income tax refund, guess what? in your itemization, you took advantage of the state tax that you paid to get higher refund, right? And now 3 months later or 2 weeks later, after you file your e-filing, you get your state income tax refund. Then IRS says, wait a moment, you just used that state income tax to get higher refund from me. Now you are getting some of that taxes that you paid back. Okay, that tax that you got paid back because of itemization of state taxes, now next year, that would be an income for you. Make sense? So normally mid-year, you get a report from state of California, let's say, that you got this much refund, which you know already. Yes, I got that much refund. I know that. But why do they give it to you? Because they want to give it to you so you kind of remember that if you itemized it, the refund that you received for federal purpose, now it's a taxable amount. So next year, that taxable amount has to go in Schedule 1. You have to report it and put it in line 1, Part 1, line 1, taxable refund from state and local income taxes. Now, is it important if you didn't itemize it? No, because you never itemize it. You just use the standard deduction. If you use just the standard deduction, then the refund you got it, good for you. Congratulations, there's no income tax on it. It's the only when you do itemization. Got it? So remember that, because clients will say, I got this, what is this for? And then you say, let me see your last year tax return. You look at the last year tax return. If it's not itemized, then that is not important. If it is itemized, that is an income. So be careful on that. And you see there are some other lines that you can go over from top to bottom. That's Part 1, additional income. Part 2 is adjustment to income. So there are a few things that you might adjust to income. For example, educator expense. Educator expense, I believe it's, maybe 350 or 400, I'm not sure. Before it was 300, but then they changed it to 350. You can look at it later on, or you can Google it anyway. Educator expense for year 2022 and educator expense for year 2023. It might be different. I remember something like 350 or 400. But anyway, that's whatever it is. That goes adjustment to income. Those are educator expense, not for type of instructors that I'm doing. It's just for K through 12. Okay, just K through 12. Let's say one more thing that here is interesting is number 16, which is self-employed. Self-employed. Let's put it in line 17. Self-employed health insurance deduction. It's an important thing. Again, we might talk about this later when we get to Schedule C, but I like you to remember this because it's important. If you are self-employed and you have utility expense, insurance expense, advertising expense, all of those expenses goes in Schedule C. Makes sense, right? Schedule C to put your business income, business expenses. The only thing doesn't go in Schedule C, it is self-employed health insurance cost that you spend as a self-employed. That doesn't go in Schedule C as a form of health insurance expense. You have to hold on to that expense separately and put it in a different place, which is Schedule 1 in this lineup. And this health insurance expense goes in 1040 page 1. Make sense? So be careful on those things that I'm trying to kind of give you hints as we go forward. So this is Schedule 1, Part 1 and Part 2. Part 2 is adding to your income. Part 1 is adding to your income. Part 2 is deducting from your income. So here we go back to let's say your book. So here is the 1040 again. You get to the point that you have other income, line 8, that you add to Schedule 1, comes from Schedule 1 to add to your income. And then line 10, it comes from Schedule 1 again, but Part 2, which is deducting from your income. Now you have adjusted gross income, which is very important number. And then we use normally standard deduction for most cases or itemized deduction from Schedule A. One more thing that might be deducted is qualified business income deduction. And then if you have a small business, you can have that 20% qualified business income deduction. And then line 15 is taxable income. And that sends us to the next page. In the next page, you have the taxes, which we just learned how to calculate it from the tax table. But we have also, as you see below line 16, we have other taxes. It's coming from Schedule 2, line 3. So I have Schedule 2 here for you. So Schedule 2 is showing us additional taxes. And line 3 is right here, but where is the line 3 is coming? Line 3 is the combination of line 1 and 2. Line 1 is alternative minimum tax. Alternative minimum tax is a tax that normally they want to charge on rich people that they have a lot of income, at least to make sure they pay a fair share of the tax. So no matter what they do, they still have to make sure that they are paying the tax that government is expecting. So that's why alternative minimum tax will apply to those, not low-income families, but those high-income individuals. And there is another tax that, again, it's important. It's advanced premium tax credit repayment. That advanced premium tax credit repayment is something important because some of your client will call to, let's say, state health insurance, and they tell to state health insurance that I have this type of income. And based on that, government will decide per some calculation, how much help do they need in advance to purchase health insurance. Okay, that's fine. But if the income that they declared is changing at the end of the year and they have more income than whatever they said to government they have, so the government says, wait a moment, if you have this much income, then you deserve less help. But we gave you already. So now whatever they gave you already, extra help to buy health insurance, and now they decide that you deserve less than that, they say, okay, we're going to take some part of it out of your, what you deserve, and you have to pay us back. So whatever you have to pay back because of that extra income that you actually have, that goes in Schedule 2. Self-employment tax goes in Schedule 2. That's tax that you need to pay. Yes.
What happens if you earn less than you declare?
If you have less than you declared, then you might get some extra help on that. Let's say you tell to government the very first day, you know what, my income, whatever it is, I don't want you to help me. I will pay from my pocket for my health insurance. And government says, okay, if that's the case, then pay the health insurance, whatever you want to pay. End of the year, you're going to file taxes. We're going to see how much income you have. And based on the income that you have, we decide how much we can help you. Maybe nothing, maybe a little bit. So they're going to give you money no matter what. Either they give you in advance and then they calculate at the end when you have your real income in here declared, or they give you, because you told them, give me nothing, doesn't mean you lose it. Just you tell them, don't give me anything right now. We talk at the end. So this is the end. Now you prepare tax return, and based on your income, the software will calculate that you deserve to get $1,000 from as a form of extra refund. You get it, and now you are happy, right? So, but if you tell them I have small income, and then you end up by having big income now, then government says, okay, whatever we gave you this much too much. You have to return it to us. So this is where it goes to line 2. And this is the moment that your clients, they get pissed off. They don't like you at that moment because they say, you don't know what you are doing. What do you mean I have to return this? That doesn't make sense. Sometimes they just leave. They go.
Does that usually happen because of the prior year? And then that goes into effect?
You see, prior year, again, they might get credit because the income was lower. This year, the income is a little bit higher. They got too much money, too much premium tax, advanced premium tax credit. They have to refund it. And this year, they will get angry. They don't like it.
Oh, I see.
Yeah, so. And that the bad thing about tax is there's two things happening. Either they are so happy with you or they are so pissed off at you. And if they're pissed off, they say, you don't know what you are doing. And I have clients that they came here, at the time of final quality review, they got pissed off. They said, you don't know what you are doing, and we never paid this much taxes, you're crazy or whatever. And they leave. I said, okay, just leave. What should I do? And then they came back 3 weeks later. Can we please do our taxes? Looks like they went few places and they got worse than what we did, or actual, maybe same thing, I don't know. But they realized to the point that, you know what, let's go back to these guys. At least they do honest job. Yes.
So for them to have this information, is that by providing you with the previous year's tax form? Because are they going to get some form that tells you what number to put in there?
Exactly. Very good question. I love that. So how do you know what to put it there? Because when you open your software, we're going to go through the training, hopefully. So when you open your software, it says, okay, premium tax credit. Those are a list of like 3-4 columns, maybe 4 columns. I'm not sure. But it says enter numbers for month of January, February, blah, blah. And then there are 4 columns. So 4 columns for January, 4 columns for March, and different numbers. You say, where do I get it? Your customer has the report. So whoever is getting the premium tax credit, they have a report at the end of the year, comes from the government, and they bring it to you. And if the numbers are same, exactly every month is the same number, there's a box that you check and say, numbers are same. And then you enter just for month of January, and then check the box, and the whole thing will fill up. If the numbers are not same, then don't check that box, and you have to enter it manually. So it takes a little bit longer time.
What do you do when you have a client that doesn't, have all the paperwork? Like maybe they got that form, but they don't have it. They move a lot. What do you still do their taxes? And you just...
I can't do it because I get stuck at that point. I have to tell him.
So you tell them you have to go
back to California.gov, whatever the health insurance website is, I forgot, and call them or go to their office or whatever, tell them the form that you were supposed to send me, I lost it or never received or whatever.
So is that part of when you do the initial interview and you're giving the people the list of the documents they need to bring in?
Yes.
That's one of the documents. So
that when we look at the customers on front desk, we look at their documents. Do you have your social security number? Do you have your W-2? Do you have this? Do you have that? And we go through that. If they don't have it, we try to catch it on that spot because we don't want to waste their time and our time to do something. 1 hour later, tell them, oh, go home. Normally, they don't like that. So we try to be a little bit more careful at the beginning to reduce headache at the end, and they don't get mad at us, hopefully at that point. We send them home. They say, you don't have all the documents. Go get these few things and come back. Because you can complete the job anyway. Or sometimes we complete the job to some degree, we save and exit the software. That's okay. They come back, they say, okay, let us go figure out where is that paper. 2 weeks later, they show up and they bring us the paper and we finish.
Is that when it's in your system, is it only your system, or can they go to some other person and it's on some central like tax system and they can go and that another person can pull up the work that you've done? No. It's like your own.
No, it's our own. However, our software, the Vita program that we are using, tax layers for Vita program, at the end of the software, it says, do you like to consent to have other Vita sites to have access to the previous, this year? And if they say yes, we click yes. And let's say next year, for some reason, we are closed or we are far away. He moved to San Diego, so he's not going to drive all the way to Pasadena City College. So he goes to San Diego, Vita program over there. But because he consent already to the thing, that Vita program over there, they're going to ask him, do you have your last year tax return? Normally, we give them a copy, of course, but let's say he lost that too. Then they go to Vita tax software and they search the name and maybe using social security number, they find that 2022 tax year return. They can copy it, print it, save it in a flash drive, give it to client, and copy the forms that they need or look at it to see what happened in 2022. Because sometimes you want to prepare a tax return in 2023, let's say, you need to know what happened in 2022. Again, good question. So here, keep going. So Schedule 2 looks like it says all additional taxes if you go line by one. In regards to employment tax, I want to just tell you this. In regards to employment tax, it might come up in Chapter 2 towards the end, but since we are talking about this, it's in Schedule 2, line 4. What is that? Self-employment tax. Self-employment tax, that means you have a business. You have an income, but you are your own employer, right? If you are working for someone, your Social Security and Medicare will be paid by your employer, half of it. The other half, they will deduct it from your paycheck. But if you are working for yourself and you make $100,000, you have no employer to pay half of your Social Security and Medicare. You have to pay the whole thing. So how much is it? 12.4% for Social Security, up to a certain amount threshold of income. It's about 140,000. Every year is changing again, so you don't need to memorize it. Just Google it. Social threshold for Medicare taxes. You will see. It's some. It's software knows also if you are using a software. The next thing is 2.9% for Medicare. So Social Security, 12.4%, 2.9% for Medicare. Add them up, that's 15.3%. So if you have $100,000 net income from your self-employment business, you have to pay 15.3% for Social Security and Medicare combined, right? So that's where self-employment tax goes. Attach Schedules SE for self-employment, 15.3% of your income goes there. Good? So far, so good. So you have to pay that. And that is another line that it will make your clients surprised and, not happy because they have to pay that self-employment. So the good thing is you have to tell to your clients that you have to pay this self-employment taxes on a quarterly basis yourself in advance to IRS. You're not supposed to wait the whole year and then all of a sudden you owe 15.3% of your income. That's too late and too much. IRS will penalize you for that anyway. So you have to have estimated tax payment in advance. The good thing about this self-employment tax, half of it will be as a form of a credit somewhere. Let me see if I can remember where that is. I think it is in Schedule 1. Schedule 1. Adjustment to income, maybe. Self-employment. Line 17, you said? No, that's self-employment health insurance deduction. There is another one. There is a self-employment, maybe in Form 1040. It should be in schedule one of those schedules. Anyway, that's half of that tax that you pay for self-employment tax from your pocket as a self-employed person. Half of it will be reduction of the income. Now, I don't remember which schedule it is. I don't want to waste time to find it, but it will be in one of those schedules and it will be deducted from your income. So that is the benefit of it, because the government says, since you paid so much self-employment tax, half of it, which your employer was supposed to pay, but you don't have employer because you are the employer yourself. So you, as an employer, you can deduct it from your income. So if you, let's say you have $100,000 income and you paid $15,300 for the self-employment tax, half of it, which is $7,000 something, will be deducted from your income. I don't know again which line it is, but I might see later on. You will see it later on, and I will point it to you. Yes.
So, and these estimated tax are paid in quarters for installment?
Normally, yeah, quarterly. That's the best thing, and you can put it on a. When you file your tax return, it says you owe too much. You need to pay estimated tax. It will be populate right away in the tax return. And we provide the your checking account information in the software. If you get a refund, goes to your checking account directly, and quarterly, it will be deducted from your checking account for the estimated taxes. Yeah, so that's the thing over there. So in page 2 of Form 1040, as you see, we pay taxes, and then we have Schedule 2, which is additional taxes that you have to pay, including employment tax that we were talking. And then we have some credits, child tax credit or credit for other dependents. So what is that? Child tax credit, it might be used right away here. But if you don't owe that much taxes and you just use as much as you need in here to reduce your taxes to zero, but the remaining child tax credit, don't think, oh, I lost it, what's going to happen? Nothing. It will get refunded to you somewhere down the road. Line 28, you see, additional child tax credit that will be refunded to you right there. So you use line 19 as much as you need to reduce your taxes to zero, but whatever child tax credit you have left, not used, it's okay, it is refundable, and you can get the refund in here. So far, so good? We come back to this page again down the road when we get to other lines. So let's move a little bit forward. This is 1040 SR for seniors. And if the taxpayer is a senior citizen, then they will use the software will automatically use this. Other than that, it will use 1040. Okay, let's move on a little bit more to the chapter. Here is showing the bottom portion of the 1040 where it shows that you have a refund or amount that you owe, and then signature, date, occupation, and identity theft protection. If you declare, you see at the bottom here, at right side at the bottom, if you tell to IRS that I got ID theft issues, they provide you a PIN number, and every year your client will get a new PIN number, and that new PIN number you need it. If client says, oh, I don't know, I don't remember such a thing. So normally if you file it like that, it will get rejected. You have to call clients, hey, you have a PIN number, you didn't tell me. If they say, oh, I don't know, I don't remember, I didn't receive anything every year, like once I remember, but this year I didn't receive anything, then it might be lost. So call IRS, try to get that PIN number for this year, bring it back so I can e-file it again for you. So you have to ask your clients, do you have a PIN number, ID PIN number? If you do, I need that updated ID PIN number for this year.
I'm sorry, when do they get PIN numbers? I don't know if I have a PIN number.
I don't have either. But if I call IRS one day, I say I have an ID theft issue, someone trying to.
It's an ID theft issue.
Yes, and then they will give you PIN, and since they give you once, every year they give you an updated one. So no one can file your tax return because they need that PIN. And if I tell you where is your PIN and you say, oh, I don't remember, I didn't receive it this year, that means it's lost, right? That means we cannot file taxes. You have to talk to IRS and try to get a new PIN number so we can file it.
And then like a situation where like someone stole your like social security number, I think that's what you ask for, like a number.
If your social security number is stolen and identity is stolen and someone tries to file taxes on your behalf to get refund, then you know that something happens, right? If as soon as you know, you have to notify IRS that I have an ID theft issue. Someone tried to file taxes or something happened. At that point, there are some forms that you need to fill up, I believe. There's some process. You open an issue with the IRS, they open an account, they start giving you a PIN number after that. So, because already your information is on someone's hands, right? That's why you have to protect whatever it's yours. Don't put it online, because the moment it goes online, you never know. Even in this office, I'm very, very picky about how we prepare taxes. Information of clients has to be in the file. You have to, hold on to the file, go to the copy machine. If you leave any social security card or anything in the copy machine, and then I get pissed off. I'm going to call you on my desk, say, hey, what are you doing here? This is a real scenario. This is people's property. You cannot just let it go. You are responsible for people's property. And, people trusting us, right? So anyway, so let's talk about it. Reduce tax rate on qualified dividend and net capital gain. Yeah, so there is a little bit lower tax for qualified dividend and net capital gain. Depends if it's short-term gain or long-term gain. Short-term gain has normal tax bracket that you have to pay taxes, but long-term capital gain means you have either 0% years. You see the line 2 years says 0% for taxpayers whose taxable income is less than 83,350. You don't need to memorize those numbers, but just as long as you know that for some threshold income, the tax rate is 0%.
What is the MFJW part?
Very fine.
Made filing jointly.
And
Yeah.
then what's PW?
Qualified widower.
Got it, thank you. Sorry.
Head of household is the next one, 55,000, and single made filing separately is 41,000. That's why you remember I said married filing separately has some negative issues. One of them is here, you see. So if you file married filing separately, one thing is here is just your threshold goes half, even less than half, or half, let's say. So that's $41,000, just like a single. So anyway, if you have up to this much income and you have a capital gain, you pay zero tax on that, right? So if you buy, you have your profile and stock profile, and then you buy and you get dividend on that, and you have capital gains. If it's long-term capital gain and qualified dividend, you, in some cases, if your income is below this threshold, you pay no taxes at all on that. But if it goes over, then yes. So here, it is 20% for taxpayers with income made filing jointly more than up to $517,200 for head of household and single, as you see here. It is 15% for all other taxpayers. So if your income is above $517,200, you pay 20% tax on net capital gain and qualified dividend. If you are between 517 as a married filing jointly and 83,000, you pay 15%. If you are more than 517,000, you pay 20%. If your income is below 83,000, you pay 0%. So you don't need to memorize it, but just understanding of there is a no tax, 15% and 20% based on your income. So it says that that these numbers are changing constantly, indexing for inflation. Okay, got it. Let's see what else we have. For FICA, I already told you what it is. If you have an employer for Medicare and Social Security, half of it will be paid by employer. It's in your W-2. So when you get your W-2, you have all those information, how much gross income you have, how much federal income tax has been withheld, state income tax withholding, and FICA taxes, which is Social Security and Medicare, has been paid on your behalf. And remember, who's paying this Social Security and Medicare? Half of it your employer will pay, which is good. The other half, normally you pay from your paycheck on a paycheck basis. So add up all those Social Security and Medicare that has been paid on your behalf, it will show on your W-2. So it's very important that you enter every single number in your W-2 correctly in the software. So you can, because the same W-2 a copy IRS has. So if you try to, or by mistake, you put different numbers, your tax return will be rejected. Be careful on that. Estimated tax payment, again, if you owe too much to IRS doesn't like it, your software will put estimated taxes that you have to pay on the quarterly basis, and you need to pay them. You cannot owe normally more than $1,000 of taxes. And if you owe more than 1,000, you have to pay estimated taxes.
Oh, okay.
Yeah, up to 1,000 is fine. But
Is that including state?
again, every state has, some states they don't have income tax anyway, but some states they have, and they have a threshold. Yeah, so normally no government likes you to owe them at the end more than $1,000. And they might put some penalty on you. Yeah. Okay, so excess FICA withholding, what is that? For FICA withholding for Medicare, Medicare is 2.9%. And there is no limit on how much income you have. You have to pay 2.9%. At the top of that, if your income as a single payer, if your income is more than $200,000, you have to pay additional Medicare tax of 0.9%. And you pay that yourself, not your employer. You pay that yourself, 0.9% of any income above $200,000 for single. I think for married filing jointly is $250, but for single, $200. So Medicare, technically, there is no threshold. You have to pay, and even it goes higher as your income goes higher. If it goes over 200,000, another 0.9%. But for Social Security, there's a threshold. You can Google it, how much it is for every year, but I'm telling you somewhere about $140,000 right now. Oh, here says 147 in year 22, right there. You see that is 147 for year 22. You pay 12.4%, which half of it will be paid by employer, half of it paid by you. If you are self-employed, you pay the whole 12.4%.
You pay the whole, self-employed pays the whole, what percent? You said?
The whole 12.4%.
Oh, it's not for married?
Doesn't matter what you are married or not.
It's 12 point Social Security, right?
Social Security is 12.4% up to $147,000 income.
Okay, and then not employed, employed is 6.3%.
If you are employed, you pay half of it, 6.2, your employer pays 6.2, which is 12.4 end of the day,
Okay,
right?
that's why.
Yes.
What would happen if, let's say you work for a small business and they pay you in cash and then they report it at the end of the year?
As a
Would they-
form of 1099?
I think so. Would you still only pay half and they would pay the other half?
Okay, that is a very common situation that some employers, they try to tell you, you're not the employee here, you're gonna get 1099 at the end. And okay, who is 1099? 1099 is a self-employed person, right? And how can you become a self-employed person? If you manage your business yourself, manage your time yourself. No one tells you come at 8 o'clock. No one tells you take a break. No one tells you go to lunch, come back. None of those. You take a job, you go do it whenever you like, however you like. The result should be complete job. Now, how you want to do it, when you want to do it, it's your choice. That's 1099. So you are independent contractor, self-employed, you do a job and someone will pay you and they give you a 1099 at the end. That's fine. But if you get hired somewhere and they say, come at 8 o'clock, take your break, take your lunch, go on back, come back these days, don't come back those days. So you are not self-employed anymore. You are an employee. And that person, that business is a crime to do that. And if you report that to the IRS, first of all, they give you a 1099. And if you come here with a 1099, we prepare your taxes, you end up paying the whole 12.4% plus 2.9% combined 15.3% FICA taxes. And if you say, wait a moment, I'm working somewhere and I go on this time, I take a break, take a lunch. I'm not in, but why should I pay all this? I said, okay, if that's the case, we need to report this to the IRS. If you report this to the IRS will not, after doing the due process, will not charge you that tax. Half of it will not charge you, just will charge you half that you deserve to pay. The other half will not charge you, but he's gonna go after your employer. Not only gonna get that money from him, but also he gets penalized because of that. He gets penalty and he will get in trouble with IRS. So that's a very tricky thing to do because if it gets reported to the IRS will go after that business. And you might skip paying that half of FICA taxes. That's fine. That's what you really deserve. And IRS will probably follow that. But IRS will go after your employee. And you get clients like that. You get it. So get ready to answer exactly the way I explained. Same thing to that employee, that person. Same thing that I said. So here, as you see, it's 200,000 for single individual. If you make more than 200,000, you pay additional 0.9% here, 0.9% additional Medicare. So if 0.9% plus whatever you pay below 200, you pay half of it at least as an employee, right? That's 1.45, right? But anything after 200, you have to pay from your own pocket 0.9%. Make sense? So, yeah, 1.45 plus 0.9, you end up to pay 2.35%.
Just a quick question on the Social Security for self-employed. Like, was it the same percentage on previous years?
Yes.
Yeah.
Percentage is same. The only thing is changing is the threshold for Social Security. You see here, 147,000, the threshold. That is the number. Normally, I don't memorize it because every year is changing a little bit.
Right.
Normally, next year, in year 2023 tax return, it will go up. Probably, I don't know, 148,000 something.
160,200.
150,200.
160,200.
Wow. Okay,
That's a
there you
big
go.
jump, right?
So that's a big jump. Normally don't jump that much, but because of inflation that we have last year, I believe, probably because of that, they jumped it so high. Normally it goes a little bit up, not that much, but anyway, so 160,000 something.
For 2023, right?
Yes, yeah, just Google it, yeah, anytime. So you just, it's all over there. This is 2022 tax year, so that's why we have numbers here. Okay, so it looks like we are fine, and let's go forward a little bit more. Tax credit. Oh, tax credit, I told you once already, it might be refundable, it might be non-refundable. So refundable one is good. A non-refundable one, those are tax credit that either use it or lose it. So if you don't owe that much taxes and you have non-refundable tax credit, whatever you use, the rest is gone. Sorry. But refundable is good because if you don't use it, you can at least get it back. Like child tax credit that I told you can be refundable. So whatever you use it, the rest you can get it back. Okay. That recovery rebate credit that was in year 2020 and 2021 doesn't exist anymore in 2022. That was just for COVID time, and it was a big recovery credit to boost people's income, but that's gone. So you can Google it if you like to see what was going on in 2020 and 2021, but we don't have time for that to discuss. That was in previous books. let's see, foreign tax credit. Okay. This is one more thing that it's important, and maybe your book doesn't cover that much, that part. So let me explain it and remember it, because you're gonna have clients that they have foreign tax credit. So listen carefully. You have clients in general. I'm not telling those clients that they work outside maybe, but they are clients just like me, that they have a portfolio, let's say stock of, for example, a European country, let's say Shell, I believe. Shell is European, right? So if you have, or BP, right? And you have those stock and they give you dividend, very good dividend, so you are happy, but normally they hold some income tax from that dividend that you're supposed to get. And then you get a report that it says, the whole report, remember I said 25-page report that you have all these stocks and you sold this and you bought this and short-term capital gain, long-term capital gain. That in the first 2 pages of summary, if you look, it shows you have a foreign tax credit of, let's say, $20 that you pay. Okay, what do you do with that foreign tax credit that you already paid to European countries, $20? What do you do? Two options. Option one, it says in your book, it says, put it in Schedule A, right there, you see? Schedule A. Option two, it says, put it in Form 116, tax credit, but don't put it in, don't choose the option A. Don't, Schedule A, don't choose that option. Why? Because in Schedule A, if you show $20 income, I mean, $20 tax, that $20 tax will reduce your income by $20. And if you are in 10% tax bracket, so $20 reduction of income multiplied by 10% tax bracket, we are talking about $2 saving of taxes. So you pay $2 less taxes. You pay $20 to Europe, but you get $20, $2 back in a year as a saving. That's not fair, right? So don't choose that option. Even though you have that option, it says here, but don't do it. So I suggest maybe instead of putting in Schedule A, choose this one. Go to Schedule 3 and choose to put that foreign tax credit as a non-refundable credit, $20 in Schedule 3. And Schedule 3, if you put anything in here, goes, and here is the foreign tax credit for 116 that I said. The software will fill up this for you. The software will put this in Schedule 3, line 1, and then that will end up somewhere here. Here, line 20. See that, line 20? Mm-hmm. It will end up there. So the $20 will reduce your taxes dollar to dollar. Exactly $20. Oh, nice. That's much better than saving $2. So that's why your client, they come to you because you are professionals. You preparing a tax return, normally you don't make mistakes, say, oh, the whole thing is wrong. Not the whole thing is wrong, but the way you did is wrong. Not wrong. The way you did is not the best way to do it. So you are not wrong. You're good. You can say, swear to God, I am not wrong. Yes. But is it the best way? No, it's not. The other type of tax credit that is in this chapter that you can read, maybe come up later on, it's education tax credit. So I remember when I was not preparing my own taxes. I was many years ago. So someone was preparing taxes for me. And then I went to I was a student at that time, and I took VITA program, almost the same thing that you are doing. And I learned about education tax credit, lifetime learning tax credit, and American Opportunity tax credit. And you need to know the difference. Lifetime learning tax credit is not a refundable tax credit. You can just use it to reduce your taxes that you owe. And it's good for lifetime. So anytime in future you go to college, 5 years from now, you pay $300 for tuition. That tuition you can use that. You get a form from the college that you use this much for tuition, $300, $3,000, whatever, and you put it in lifetime learning, and you get non-refundable tax credit as a lifelong learning tax credit, which is good, right? But we have another type. We call it American Opportunity Tax Credit. And in this chapter, you might see it. American Opportunity Tax Credit, it is partially refundable. And there's a bad thing about it. The bad thing is you can use it only 4 times. Remember, only 4 times. So if someone goes to community college, just, year 1, not that much serious to go all the way down. So don't waste American Opportunity Credit, because if you waste that for small tuition that he paid in community college, that year 1 is gone. You have 3 more years to use. You killed just 1 year because of you don't know what you are doing, right? So normally you explain to what's your purpose? What are you doing? What's where you're going to end up? Are you going to 4-year college? Because that American Opportunity is up to bachelor degree. Got it? Up to bachelor degree. So you use that American Opportunity Credit up to bachelor degree 4 times only, and is partially refundable, right? So the tax preparer that was preparing my taxes, he used lifetime learning. And I told him, I brought it home, I look at my tax return. I signed already, but I look at the tax, I say, oh, what? No. If right now we use, because this is my 2nd year of college, and I'm gonna go for 4-year college. Okay, year 1, we did lifetime learning, I understand. Year 2, I took a lot of courses. So I paid a lot of tuition. So let's use year 2. And American Opportunity, you can use supplies, books, computers, laptops, tablet, anything that you want to use for your education expense. Not parking, okay? Not college parking, no. But supplies, including computers, laptops, those. So you can combine all those. If your client doesn't have those information, go get it. Go home, get those, come back. I need all those. Because this is your year 2 of community college, you're gonna go to 4-year college. Now it's time to start nailing this, because we can use it for 4 years. Year 1, use lifetime learning. It's not a big deal because they took just 1 semester, not a big deal. But year 2, they got serious, 2 semesters, summer semester, winter semester. So now they are having a lot of education expenses. So you use American Opportunity, and it's partially refundable. So I went back to my tax preparer. I said, instead of using lifetime learning, use American Opportunity. He said, you're not qualified for American Opportunity. Lifetime learning is good. That's what you qualify. I said, no, I do qualify. You can study if you like, look at your documents, publications, whatever, and make sure you fix this, change it to American Opportunity, because if you do, based on my just paper calculation, I will get few $100s back. It's like something $500-600 more refund. And he said, okay, let me look at it. So he looked at it. He called me back. He said, okay, you were right. I fixed it. I printed the whole tax return so you can sign it and have your wife sign it and then mail it to IRS. It was a paper return at that time, many years ago. E-file was not that much popular at that time. So he reprinted it and I got $600 more return. So did he do wrong for me? No, he did good, but he didn't do good enough, right? He didn't ask me critical questions that you as a professional supposed to ask. Ask questions. What's your purpose? Where are you going? Why you are taking college? How many units are you taking? And all those you end up by having a good interview. So you put your client in the right spot. Yes.
So like in my case, I already have a bachelor's degree and I'm just taking classes. So then I would use the lifetime learning credit
Yes.
at that point. Anyone who already has a bachelor,
You're done.
it's too late.
Now,
And can you use it on the tuition you're paying for your children? Or that's,
of
No.
course.
oh, you can.
Oh, yeah. Yeah. For every single children, you use American Opportunity Tax Credit. Yes. Yeah. Lifetime learning is just one thing. It's not like every children. But American Opportunity, let's say you have 5 children, every children has American Opportunity that can be used 4 times. Got it? So you have to keep track of all your children who got American Opportunity how many times. That's why you normally ask that, bring me your last year tax return. How about the year before that? Did you use American Opportunity year before that? Because I need to know how many times did you use it for this child? And the second child, the same questions again. How about the third child? The same question again. Yes.
Will it be rejected if it has been used more than 4 times?
Of course.
Oh.
Yeah, it will be rejected. Or if it's not rejected and they figure out down the road, they will send you a letter, say, hey, based on things that we just figured out, looks like you used this 5 times and now you owe us this much.
And penalties too, I would imagine.
And penalty, everything in between. Yes, of course. IRS will do that, everything. So you don't want to make a mistake. So your job is as a professional tax return preparer to talk to your client, know your client, how many children they have, who's going to college, how many times American Opportunity has been used for every one of them. Now, look at my story so you know why it's so important to do good for your client. So in that year, I asked that tax preparer for me, and that was the last year he did it, because after that I was good already, but I just want to give him one more tax return before I cut my relation, because I started preparing taxes myself in WITA program. Now I knew what to do. I was so-called, professional now, and I want to do it myself. But that year I said, let him do it since he did so far so many years. Anyway, I asked him to change it to American Opportunity. So guess what happened? Listen carefully because it's important. So in that year, it was my second year of college, I used American Opportunity. That's year 1. Year 2, American Opportunity, that was my first year of 4-year college. Got it? So I used it again. Year 3, I used it again. That was my second year of 4-year college, right? So far so good. How many times did I use? 3 times. One time I was in second year of community college, AA degree, and then 2 years in regards to bachelor. But then I have 1 more left, right? But at 1 more left in the, let's say in the spring, I was still in the bachelor last classes. So I use that, right? I can use it, right? But because that year, spring was bachelor, but immediately in fall, I start my master degree, and the bachelor and master falls in the same year, spring of bachelor, fall master. Because fall bachelor and master falls in the same year, I am entitled to use American Opportunity one more time, even though half of it is coming from my master program. So I paid much more money for master program, obviously, but because still I was in the fourth year of half bachelor, half master, I was entitled to do that. So I milked it the whole way down to the last cent to use every single opportunity possible so I can get maximum education tax credit. So the program of tax planning is very important. So you do something today, your client gonna see the result 4 years down the road. And you explain how I did it, why I did it 4 years ago, this thing for you, so you can get this result today for this child. Obviously, we're gonna be careful for child number 2 and child number 3, so we can have a good planning down the road. Make sense? So be careful on that. American Opportunity Credit, supplies, computers, books, yes. Lifetime learning, only what? Only tuition, nothing else.
I'm guessing you would need to just collect all the receipts.
Exactly, you need to collect all the receipts. Yes, you have to tell to your clients, anything it's related to education, have those receipts. Add them up, put it in Excel, staple the receipts, have it, because you get audited, you need to show. Otherwise, they will take it away, charge you back, plus penalty, plus interest, plus everything else in between.
Is there a resource online that shows us what qualifies as an educational expense?
I just told you, tuition for American Opportunity,
Yeah, for American.
tuition, supplies. No room and board, no parking permit, just tuition and supplies. Supplies includes what? Book, pencil, pen, computer, maybe a laptop, maybe a tablet or something, whatever you use. Yeah. So that's a good time to buy a computer. So if you want to buy a computer, don't buy in year 1, because year 1, in community college, you're gonna use lifetime learn credit. So don't buy the computer, hold on, borrow a computer from your college and then buy it next year. Make sense? So you can put it in American Opportunity. Again, tax planning. That's a good computer is about $1,000, right? Anyway, you got the idea? Questions so far? No? Okay. Again, this stuff I'm gonna put in YouTube, and hopefully every year I will follow up with the same process I decided to do. And you can have access to this even next year if you like to listen. See you next time. Going over chapter 2 again. If you have any questions about chapter 2, study and bring it and we will talk about it. Okay? Thank you.